All right, let the viewers know why you're back here. And for the people who don't know you, what's your name and where you're from?
Yeah, so we've been in the studio one time before, but for viewers, that is the first time in seeing my face. I'm Milo, 20 years old, and what place do I live in worldwide? I've been to many countries around the world. Miami, Thailand, Mexico, Colombia, pretty much any country you guys can name. I've been there and I've visited that place. Back in 2021, that's when I first came across ICT. I was trading the market maker model and also the 2022 model. And both of them combined, I wasn't really finding profitability for a very, very long time until eventually I reached my first payout. There was many ups and downs whilst I'd been trading, especially the first 3 years. At one point, I didn't even believe I could make any money at all. I thought trading was a scam. I thought that anyone who does trading literally cannot make any money at all until I actually sat myself down with a set of rules, stuck to it, eventually worked towards a consistent model that turned me profitable.
I've lost a lot of money trading. Let's be real. And I've been there. And there's a lot of psychology work that gets tied to it. No?
Mostly psychology. A lot of traders, they get stuck on the psychology aspect of things. They know exactly what they're doing. They're on the edge of the cliff to becoming profitable, but then they drop off because their psychology is not there. They can't have the patience to wait for the model to present itself, and trading your model and waiting for it to present itself is two different things. Because the model itself, I take around 1 to 3 trades a week. There's traders on YouTube promoting 5 trades a day. I'm simply only taking around 1 to 3 trades a week. Last week I didn't even take a trade. And there's weeks like that, and a lot of traders, they're gonna then tilt and everything's gonna go out of the window, including their accounts, on a week when they don't have the patience in order to wait for the model. Patience is the key.
Right, so you trust yourself to be able to make these trades. Like, you have the discipline to be able to go there. Like, what was the first time, like, describe the first time where you got beat up essentially by yourself, right?
Yeah, exactly. I mean, if you put it this way, a lot of traders, to get to the point where they want to be, they still have to follow the same approach as someone who is where they want to be. There's no shortcut, there's no fast cut route to get to the top in any sort of business that you run. You can't shortcut anything in life, especially when it comes to trading. You're only one mistake from going back all the way to the start. You could be trading for the whole year on a prop firm account, scaling up those accounts with a bigger drawdown, getting consistent payouts. One day comes across, 2, 3, 4 days comes across, the 4th day your accounts are gone and you're back to square one. You have no capital and you almost feel lost and unprofitable, and that can happen in the matter of a day. The difference is, leading back to the point of patience is actually what keeps you on the tracks. Otherwise you can go straight off the tracks and back to square one. And to actually reflect back and look at your past self getting payout after payout after payout, that is what gives traders who are already there the confidence that they can have the patience to wait for the model because they know it's profitable. But for the traders that are watching this video and they possibly have never been paid out, they've never received any sort of income from trading, it's difficult to look back on something where you don't have proof in the product, proof in yourself from actually getting paid out, right? So to get to the point of actually looking back on consistent payouts, you still have to follow the same process, the same approach, the same model, and the same ultimate process that actually brings you to being consistently profitable. You know, the fast route is the slow route in trading. So the slow route of, you following your model, waiting for the model to present itself, taking the trade, that's the fastest route to becoming who you want to be. And the slow route, right, is the fast route. You trying to speed everything up, taking 5 trades a day, trying to pass that account in the same day, trying to get paid out the next day. That's going to bring you back to square one, and you're going to go in that addiction cycle. This is what I call it. It's an addiction cycle where month by month after month, they don't really see any progress because every day they're trying to speed up the process. They're going back to square one, and they're just in this constant cycle of basically wheel spinning, going nowhere.
Are there things that you love to do when you trade? Like, how do you prepare yourself for maximizing that moment?
So every single day, I have the same structured approach. Some traders, if you ask them, especially ones who find themselves to not be very confident in their own model, is because they're trading different models every single day. They don't have the same structured approach each morning in the New York session when they approach price. One day they're going to trade the continuation model, the Eiffel Valley Gap model the next day, and then the unicorn model, which sounds like a weird model. I don't know why they've named it as something LGBTQ or the unicorn, but that's what it's called. That's the model that I personally trade myself, and that yields the highest win rate and only occurs around 1 to 3 times a week. Sticking to one model and the model that you know best is what everyone should be doing. They shouldn't be bouncing from model to model. You should have a fixed R multiple instead of, say, looking for a 5-to-1 risk to reward one day and then the next day they're taking a 1-to-1 risk to reward. That's all over the place. That's not going to offer you a consistent win rate, because the win rate that turns you profitable from a 5-to-1 is probably going to sit around 30%. But for a 1-to-1 risk to reward, you only have to have, anywhere of a 70% win rate, because it's a lot easier to catch a 1-to-1 than catch a 5-to-1 risk to reward. That's the difference. You need to have a specific model that you stick to every single day, a set risk to reward, and the same structured approach each day.
It's almost like you're a hunter, right? Like you're waiting for it to come up.
Exactly.
You're not just shooting everywhere. So are you looking at in one specific market?
Exactly. I mean, there's people bouncing and dabbling in and out of different markets. You have to be a professional in your field. So you can't one day be in crypto. Crypto is long-term investments. I'm not trading crypto day to day. When it comes to actually in and out intraday price action inside of macro time windows, the 3 macros I specifically trade is the 9:45 a.m. to 10:15 a.m. macro, 10:45 a.m. to 11:15 a.m. macro, and then you have the start of the lunch macro, which is at 11:45 a.m. to 12:15 p.m. This is all in New York time zone, and these 3 macros is the ones I specifically trade. I'm not sat there all day for 6 to 8 hours, as some people may suspect a trader to sit there for 10 hours straight. I'm there in 30-minute increments, looking at each macro and looking for a specific model, specific checklist that I follow each day. I execute based upon that checklist, not based on emotions, not based on how I feel that day, and I don't go based off a random dollar amount. I'm only risking the same dollar amount each day, the same amount of contracts each day. Everything can go south when rules go out the window. There's a fine line between gambling and actually being a professional trader at the end of the day. So you don't want to be falling off the cliff, as I mentioned in the start of the podcast. That's the fine line. Psychology, risk management, executing the model are the top 3 right there.
What would you say is the best trade that you've ever done?
The best trade I've ever done, I would say they're all similar trades. There's not a trade that would probably glow and stand out from the rest of them, but there is a trade you can recall back on this YouTube channel, possibly back in January. It was on the 27th of January. You guys who use TradeZeller can backtest this. And it was 168 handles inside of the New York AM session, which relates to a dollar amount depending on your capital. I mean, you can make $100,000, you can make $1,000. Depends on your capital at the end of the day. The pairs I trade is NASDAQ futures, and I split my screen into 2. So a lot of people, they're too focused on the NASDAQ itself, but it's very important that you look between the 2 pairs, NASDAQ and ES, in order to look for correlation between the 2 pairs. If NQ displaces, you want to ensure that ES is displaced as well. You can also look for differences such as an SMT, and if, say, NQ swept London highs and ES hasn't, then obviously you're going to have an SMT which is bearish on ES. So it's very important that you look between the 2, as there is confluences that if ES doesn't, say, displace, then that's going to go against the trade and make it lower probability on NQ.
So when VIX usually spikes up, we're just going to see buy dumping a little bit.
So usually the VIX would stand down for a possible sign of an early recession, but it's not something I pay attention to on a day-to-day basis. So each day approaching price, I'm starting on the daily time frame, and I'm understanding the next daily candle draw. This is very important that you understand where is the next daily candle likely to draw to. Once I understand whether it's going to be a bullish next daily candle or a bearish or neutral, and the way I determine that is current imbalance it's in. Too many people that sat there in their chair, they're just sweating. They don't understand where the candle's going to draw to, because they're looking at order blocks, breaker blocks, mitigation blocks. Oh, it swept previous week high or previous week low. All that you have to pay attention to understand the draw is the most recent imbalance. If you're in a bullish daily imbalance, your bias is bullish. If you're in a daily bearish imbalance, your bias is bearish on the daily. Then you drop down to the 4-hour time frame, then the hourly, and it's the same approach to understand each hourly time frame for the bias. Hourly bias, 4-hour bias, daily bias. If you have each time frame which corresponds with each other, then obviously you're going to have a stronger bias. If, for say, some days the 4 hours bearish and the daily's bullish, that day you're going to lean more neutral, right? As you come into the New York AM session, then with a neutral bias, you then look for price to unfold. For example, let's say you're between London highs and previous day low, then you're going to look for price to manipulate either above London highs or below previous day low. Once you've seen that accumulation, then manipulation, then distribution, as many of you guys will know, that's the power of 3 model. And that paired with, say, a Judas swing at the New York Open, as the model I just presented to you guys, the unicorn model, as many of you guys are familiar with. How many times have I broke it down on the YouTube channel? Many times. You guys can correspond that over to other videos on my channel, but that right there is going to be an A+ setup. Obviously following the checklist, and guys, I'm going to run you through the checklist right now. The checklist itself is going to be your overall bias. Number 2, you want the bias has to be paired with a sweeper liquidity. Let's say, for example, you've worked through the time frames, you've now come towards a bullish bias. We've now swept, say, a point of liquidity such as London lows. From that point, London lows has been swept, you have a bullish bias, you've now swept London lows, let's say you've tapped into a higher time frame imbalance. Now you're going to be looking for longs, of course. Now you want to see a shift in market structure inside of macro. As I mentioned previously, a shift in market structure on both NQ and DS. This is essential. You also now want to see a fair value gap paired with either a mitigation or a breaker block on either NQ or ES. Doesn't have to be both. And an SMT is a confluence. It's not essential. You don't need an SMT. It's only a confluence. Then amongst the 5 and 15 minute draw. So as I've evolved over time trading ICT, I've implemented more rules. And as you guys would as well, you're going to become more consistently profitable. You're going to improve as a trader over time. When I first approached ICT, I didn't have this rule. And this is something I implemented as of 2025. I took the results from 2024. I backtested the whole year. Every single trade I took through that whole year. It took me around 3 days of backtesting, which was around 12-hour sessions on each. And I came to a conclusion that if you understand the 5 and 15 minute draw, if that goes against the trade you're going to take, then that acts against your trade. That now makes it a B plus setup. I'm taking that with half size. And if I don't have another confluence, then I won't take the trade. Everything else has to be perfectly fine. What I mean by going against the 5 and 15 minute draw is if, for example, you're looking for longs, therefore looking for a buy position, if that, for example, trades into a 5 or 15 minute bearish gap, that is going against the trade. Let's say you're looking for shorts in a different example, vice versa. If you're trading into a 5 or 15 minute bullish gap and you're looking for shorts, now that's going against the trade. And that's automatically going to turn it into a B plus setup, which of course you take with half size. So hopefully I give you more of a rundown and that kind of makes sense.
That $1 per contract quickly spike, right? Especially when it's like intraday trading or you have like, tight expiration.
Like options.
Right. You ever done anything like that?
So I started on options actually. And originally starting with options, the alphas and the Greeks is very, very complicated topic. Futures is a lot more simpler and the way that futures moves is a lot more tick by tick. And it's a lot easier to understand futures than it is with options. The way that futures moves, I much prefer it. It's a lot cleaner. And that's why I've moved over to futures. I used to trade options. I've also tried trading Forex pairs, which I was profitable in. That's why I have an FTMO account to this day. Because originally I transitioned from options to Forex, which then I got max allocation funded with FTMO. And then from that point, I still trade my FTMO account using US 100 because US 100 moves the exact same as NASDAQ futures. There's no difference at all. The only difference is the dollar amount of the contract. US 100 is indices and NASDAQ futures is futures, but the chart's the exact same. So I trade NASDAQ futures. And so many traders that I see on YouTube, I've been watching video after video after video in order to understand one model. And I see many, many traders all over YouTube and they never can tell you an actual specific checklist that they follow. They would just say, I'm taking shorts here, guys, with no reason behind it. Where is the reasoning behind actually taking that trade? You don't really see a reasoning behind majority of traders, especially on social media. The ones off social media are the ones that follow an actual checklist and have a consistent model that they trade. And I don't see of many traders, there's a select few on social media that I follow myself. They have a model that they trade consistently, and this is why they pull in consistent payouts and are profitable. But there's many other traders that are for stunt, or they show you a 10-to-1 risk reward on Instagram that's on FX replay. There's a very fine line between these traders on social media, and I can see right through it is that they don't have a consistent checklist or the reasoning behind the trades they've actually taken. It's always the dollar amount, of course. And whenever they're in a trade, if they're up $1,000, they think, I'm up $1,000, let me take it off the table now and call it a day. The market doesn't care how much you've made that day. It's all about the trade you've taken. If it's not hit TP, there's no reason why you should close out. If you told yourself before taking the trade, because you already knew you was going to be up $1,000 on that trade, $10,000, $50,000 on that trade. If you told yourself you was going to close out for a negative R multiple, then you definitely wouldn't not have taken that trade because it wouldn't have made sense. I look for a bare minimum of a 2-to-1 risk reward at a minimum. Yes, we can take a 1.8-to-1 risk reward. That is the bare minimum requirements of a trade I'll take. If I was to close out, say, midway of the trade because I'm up a certain dollar amount, I'm not now going to close out a 1-to-1. Overall, that's going to affect my win rate and massively affect the amount of money that I take home each month and at the end of the year. So it's very important that you just don't go based off what you feel like. You execute the model that you've seen in front of you. You have a set risk reward. You target, say, a point of minor buy side, internal range liquidity, or a premium or a discount. Then you look for a 2-to-1 and you don't prematurely close out of that trade at any point.
Yeah, it's almost like the anxiety gets to them and they close out because they think it's going to reverse on them.
Exactly.
What if I would have just held on? And then, because obviously the discipline has led you to know that the model says, keep it. There's no reason to get off. Do you get back in that trade or not? Like,
I know
what
exactly what you're saying. Yeah.
Like, do I get back in?
Yeah.
I pulled off at 1.2. Should I get in and aim for another 0.8?
Yeah, I know exactly what you're saying. And obviously, when I was new to trading, I've made all the mistakes that anyone has ever made to do with trading. I don't know a mistake that someone else, they're going to tell me that they've made a mistake. I've already done it. So there's so many mistakes that I've made, I've learned from, which has led me up to where I am today. To take those mistakes, a lot of traders have to go through it because I can tell them not to do it, but they're still going to make the same mistakes. And that's majority of mistakes are psychological. That in itself takes a lot of time to learn, and some people can't learn from me telling them how to improve their psychology. It just happens over time, and they have to make those mistakes to actually become who they want to be. And, following that model each day, taking the right trades is very, very difficult because it's very easy to say it, but it's not as easy to do it because days go by, weeks go by. Yes, you've only made $1,000, but you don't see the snowball effect, right? The snowball effect of you starting with one 50K account, getting paid out $1,000. You're sat there like $1,000 is nothing, right? You go down to Brickell in Miami and that could be a dinner, right? But the snowball effect of then you scaling your accounts, having 5 accounts, 10 accounts, 25 accounts with different prop firms. Now you're talking 10, 20, 30K payouts. Now that's going to get you a little bit further, right? Now you're talking maybe you're getting a car. Now you're getting a nicer apartment. But people only reflect on, materialistic things, dollar amount coming to their bank. But in order to get to that point, you have to start small and scale up like any other business. You don't see Apple, Microsoft scaling straight to selling 1 million iPhones a month without selling one iPhone at the start. You've got to scale up. Exactly. And also going back to what you were saying before as well about closing out of a trade midway, if that ever happens, that's a mistake on your end that you've made yourself. So you going back in to make another mistake saying, this trade's still valid, I want to get back in. No. You were decision maker behind closing out of that trade prematurely. That's your mistake. Now you have to sit there. Okay, I'm out of this trade now. It's only a small profit. I should have made this much, but you've made that mistake. Deal with it. Go to the next macro. But from that point, if you are in a profit, regardless on the dollar amount, regardless on the handle amount of that trade, I'm closing out fully and I'm done for the day. All costs. If it's a winning trade, I close out and I'm done for the day. Laptop's closed. I've got other businesses to run, right? And if I take a losing trade, then I can approach the next macro and I approach looking for A+ trades only. And I can only take one more trade. So a maximum of 2 trades per day. If that second trade's a loss, which does happen, I'm closing the laptop and that's it. I'm done for the day. And when it comes down to risk management with prop firm accounts, a lot of people are saying, what happens when your account only has $500 left on the prop firm account or $1,000 left? Do you still use the same full position size on these trades? The rule that you guys want to apply by on prop firm accounts, it doesn't matter whether you're trading a 300K evaluation or funded account or a 50K funded or evaluation account. That drawdown, which is the original drawdown on that account, let's say it's $2,000. You want to use the 75% rule of 2,000 times by 75%. That's going to give you $1,500, right? That $1,500, if your account ever drops below $1,500 of drawdown left on that account, you want to remain at half position size until you get back above 85% on that account. Once you're back above, then you can go back to full position size. But that there is going to give you double the amount of trades because you're halving size in order to actually lose that account. How many trades is that, you may think? Well, it's actually 10 losing trades. If you take 10 losing trades consecutive back to back, you're going to have to go back to the drawing board and relook at your model that you're trading because something's not clicking or it's not going right. Because I haven't done that myself in a matter of 2 to 3 years trading ICT to lose 10 trades in a row.
Are those what you would consider your non-negotiables?
That there in itself is just a set risk management rule for prop firms. Applying the 75% rule is 75% times total drawdown is going to give you a figure, right? And if you drop below that certain number, you're on half size until you get back above 85%, and then you can stay at full size and then continue to trade that account. There's also ways to scale prop firm accounts as well. And one thing, the prop firm illusion of having a 300K account and a 50K account. What's the difference? Well, we're talking drawdown. If you get funded a 300K account and your friend gets funded a a 50K account, relatively you have the same account size. You're not funded 50K and you're not funded 300K. The difference is drawdown. Let's say, for example, you have a 150K account. There's a 4.5K drawdown, and then you have a 50K account, it's 2K. If I scale up the 50K account after, say, a few winning trades, and I'm up to a 5K drawdown because it stops trailing at $50,000, now I've got a $5,000 buffer. The 150K account starts with a 4.5K drawdown, right? That is now the same as the 50K because you've scaled up. So you can scale a 50K account to, say, a 5K buffer, which is now bigger than the 150K. So you can convert a 50K into a 150 just by scaling up and having a larger buffer. And therefore you can trade more contracts, make more money, and scale up from there. So me personally, I don't have the greatest amount of patience when it comes to other things outside of trading. And I also struggle from a few ADHD symptoms that obviously gets my mind bouncing from different thoughts all of the time. And as many people watching this video can probably, correspond between ADHD symptoms, is that it's very hard in order to actually wait for that trade because your mind's always jumping from the fact that you want to be profitable now, you want to pass the account now. And that in itself is going to lead you back to square one every single time. And for those of you watching this video, I know you're going to understand the same thought process as myself, but you need to write this down in order to actually stop making the same mistakes that you do day in and day out. If you actually want to make yourself turn consistently profitable, then you do need to follow the same set of rules, the same model each day in order to get to exactly where you want to be. There's no fast route in order to make it to exactly the capital and the payouts that you want to receive each month. Some things that I'd avoid at all costs is trying to rush the process, as I've mentioned many times, is that you don't want to approach the New York AM session and never have expectations, because some people, they're going to be on a call with their friend in the morning and saying, are you making money today or what? That's what I used to say to my friend. I said, are you making money today or what? And the day we didn't make money and we actually lost money that day, then we'd lose even more and blow all the accounts because we wanted that day to turn profitable. And the day it wasn't profitable because we had expectations to make money, then we couldn't, ego steps in the way. You already told yourself you're closing out profitable. The best thing and the best approach is to say, I'm going to lose money today, and if the outcome is profitable, then so be it. You're obviously going to be on the bright side of things. But if you don't have expectations to make money that day, it's a lot easier to control your emotions because you don't have expectations. Expectations for anything is obviously going to throw you off the tracks. And vice versa, my face is going to be the same if I take a loss or a win. It doesn't bother me because I don't look at the daily result. This is not a day-to-day paycheck that we get paid by. We look at results month to month, year to year. And even of last year and the year before, I always do a full yearly reflect on the trades I've taken that year. How can I improve? Is there a checklist that I could add extra on cancelling out the losses that I've taken from last year? Is there a new rule I can implement, like the 5 and 15 minute rule that I implemented as of 2025 from 2024's results? Also reflecting each week to this day. Yes, I know, and I rarely make a mistake, but even if it's a winning week completely, I'm still going to reflect back on TradeZeller and look at the past trades I have taken myself. Just because it's a winning trade does not mean I did everything correct, right? A lot of people can go to the casino, play roulette, have 5 wins in a row, and think they're the best gambler. They think they're like Toji, right? And they can hit, every single time. Just because you're making money doesn't mean you're doing everything right. There's always room for error and there's always room for improvement. So guys, we're going to wrap up the podcast here. If you've enjoyed, make sure to drop a like on this video. It's going to be on Instagram and multiple platforms as well. Subscribe to this channel. We are on the road to 100K subscribers. We're currently down in Miami. This is the best podcast studio in Miami and in the world. And if you've enjoyed this video and whatever you want to see in the next future videos, drop a comment as well and let me know what you want to see next. It's coming soon, and I'll speak to you guys shortly.